Imagine finding out that you've been volunteering literally $100,000 of your own money to the IRS every single year.
Right, just handing it over.
Yeah, and simply because you checked the wrong box on a form like 5 years ago. Welcome to the deep dive.
It's a painful realization for a lot of people.
It really is. Today, our mission for you, the learner, is to fix exactly that and build an airtight strategy to protect your wealth.
And to do that, we are dissecting a really fascinating stack of proprietary training documents. They're glossaries and checklists from a group called 1099 Anesthesia Advantage.
Specifically, their updated 2026 editions, right?
Exactly. And, while these manuals are technically tailored for independent anesthesia providers, the underlying mechanics apply to, well, virtually any high-income independent professional or 1099 contractor.
So usually when we talk about high-level professional work like surgery or anesthesia or even complex engineering, there is this expectation of absolute precision.
Right, there's no room for guessing.
Exactly. Like you break a bone, the x-ray shows a jagged white line, and the doctor points and says, there it is. It's visible. It's clean.
It's a very binary environment.
Yeah. But when you take those same, highly skilled professionals and drop them into the world of advanced tax law and retirement planning,
The X-ray machine just breaks.
it totally breaks.
Yeah.
Suddenly, we're looking at a diagnostic landscape that is incredibly murky.
Well, the transition from clinical or technical mastery to financial mastery is notoriously difficult. The rules of advanced tax planning are just not written to be intuitive.
No, not at all.
They are written in this layered, incredibly dense tax code. But today, we're going to navigate that labyrinth. We're looking at the specific mechanics of solo 401ks, mega backdoor Roths, and cash balance plans.
And most importantly, we're going to unpack a highly specific 2026 tax rule change that is actively breaking standard retirement plans right now.
As we speak, yeah, it's a massive issue.
Look, I know IRS language can feel like reading a phone book, but stick with us here. The payout we're talking about isn't just, a slightly bigger tax refund.
No, we are talking about millions of dollars in compounded tax-free wealth over the course of a career.
Millions. So
Yeah.
before you can build a massive tax shelter, you have to know what materials you are actually working with. The very first document in this 2026 stack is like a 30-second self-assessment.
And it proves a really important point. Confusion over vocabulary is the #1 barrier to entry.
Right. You don't need to know the entire tax code. You just need to know the specific definitions of your financial tools.
The professional brain is so fascinating to me. I mean, a surgeon can memorize thousands of anatomical structures, but will completely freeze when presented with financial jargon.
Totally frozen.
But this glossary emphasizes that vocabulary is not just semantics. In the eyes of the IRS, vocabulary is the literal foundation of tax law compliance. A misplaced term changes your entire legal standing.
Okay, so let's unpack this with an analogy. Think of retirement accounts like luggage.
Mm.
A standard IRA is basically a carry-on briefcase.
Right, it's portable, it's easy to handle.
But it has very low contribution limits. A solo 401k, on the other hand, is a massive steamer trunk.
Which is what you want.
Right.
Huh.
But if you try to pack a steamer trunk's worth of money into a carry-on briefcase, the IRS is going to charge you massive excess baggage fees.
In the form of brutal penalties, yeah. And let's look at another critical distinction in the glossary. The difference between a standard backdoor Roth IRA and the mega backdoor Roth.
Because they sound basically the same.
They do, but they're not. A standard backdoor Roth is just a simple two-step workaround for high earners to get, a few $1,000s into a Roth IRA when they normally make too much money to contribute directly.
Okay, so just a small workaround.
Right. But the mega backdoor Roth is an entirely different mechanism. It utilizes a highly specific, optional sub-account inside a 401k to move tens of thousands of dollars into a tax-free environment. Yeah, and confusing the two leads to entirely different sets of paperwork.
Which leads us to one of the biggest traps mentioned in the glossary, right? The pro rata rule.
Oh, yeah. The pro rata rule is dangerous.
The text points out that simply having old, lingering retirement accounts can destroy your whole strategy. But it specifically mentions a simple IRA and a SEP IRA.
Yes.
For the listener who might have, set one of these up ages ago, what exactly are they and why are they such a problem?
Well, both are retirement plans designed for small businesses or self-employed individuals because they are notoriously easy to set up. A SEP IRA, for example, is essentially just a traditional IRA with higher limits for business owners.
Sounds great on paper.
Right, but their simplicity is a trap if you ever want to do a backdoor Roth conversion. The pro rata rule dictates the IRS views all your traditional SEP and simple IRAs as one giant pool of money.
Wait, so mechanically, how does that actually ruin the Roth conversion?
Okay, think of it like trying to pour a glass of pure, filtered spring water.
Which represents my brand new
Uh-huh.
post-tax money.
Exactly. You're trying to pour that into a giant jug of muddy, traditional IRA water. Your goal is to scoop just the pure spring water back out and put it into a Roth account.
I'm guessing the IRS says no.
The IRS says you absolutely cannot do that. The moment the water mixes, every single scoop you take out is now a proportional muddy mix.
Uh-huh.
So if your total IRA balances are 90% pre-tax muddy water, the IRS is going to tax 90% of whatever you convert. It completely defeats the purpose of the backdoor strategy.
That is a brilliant way to picture it. Okay, so if an old SEP IRA is basically a muddy water trap, and a standard IRA is just too small to act as a proper tax shelter.
What vehicle actually works?
Right. What gives us the clean slate and the massive capacity we actually need?
The foundational vehicle is the solo 401k. It is completely immune to the pro rata rule.
Really? Immune?
Yes. The IRS treats a 401k as a distinct, separate container. Now, it requires more paperwork to establish, but it isolates your money from that muddy water calculation.
Okay, but this specific steamer trunk actually has two completely separate compartments that you have to manage.
Right, it's not just one big open space.
And for 2026, the combined contribution cap for a solo 401k is a staggering $72,000. And if you are 50 or older, it jumps to $80,000.
But you don't just, write a single check for $72,000 and call it a day.
Yeah, you have to understand the two distinct buckets.
Bucket number one is the employee elective deferral. For 2026, the limit there is $24,500.
All right.
That is the money you defer straight from your own paycheck, just like you would at a standard corporate job.
Got it. And bucket two.
Bucket number two is the employer profit sharing bucket. This allows the business side of your operation to contribute up to 25% of your W-2 wages into the plan.
Okay, and this brings us to the S-corp math, which honestly always twists my brain a bit.
It trips up a lot of people.
Because to capture that maximum employer profit sharing amount of roughly $47,500, the business owner must intentionally pay themselves about $190,000 in W-2 wages.
Yes, that's the magic number.
But wait, as an independent 1099 contractor running S-corp, isn't the whole point of the S-corp structure to keep your W-2 salary as low as legally possible?
Right, to save on taxes.
Exactly. If I pay myself $190,000, I'm getting absolutely hammered on payroll taxes.
Yeah.
Why wouldn't I just pay myself $80,000 and take the rest as owner distributions?
Well, the tension you're highlighting right there is the core of advanced S-corp planning. You are playing the role of both the employee and the employer.
Right.
And the IRS is closely watching both hands. Yes, in a vacuum, S-corp owners want low W-2 wages to minimize Medicare and Social Security taxes. But remember, the solo 401k employer contribution is strictly limited to 25% of that specific W-2 wage.
Oh, so if I only pay myself $80,000.
Your employer bucket is capped at $20,000. You are leaving $27,500 of incredible tax-sheltered space completely empty.
Wow. So it really is a balancing act.
It is threading the needle of reasonable compensation. The sources point out that at a 35% federal tax rate, sheltering that full $72,000 saves you over $25,000 a year in federal income taxes alone.
That's huge.
And if you live in a state like Pennsylvania, with its 3.07% flat income tax mentioned in the text, you are saving thousands more.
So you raise your W-2 just enough to maximize the retirement bucket.
Exactly, because the massive income tax savings generated by the 401k completely dwarfs the extra payroll taxes you incur to get there.
Okay, so you get the payroll math right, you fill the two buckets, and the solo 401k seems perfectly optimized.
On paper, yes.
But here is where the diagnostic landscape gets incredibly dangerous. Just when you think your strategy is airtight, a massive new 2026 IRS rule comes into play.
This is the scary part.
The paperwork you confidently filed with your broker a few years ago might now be a ticking time bomb.
Yeah, we are looking at the Secure 2.0 Roth catch-up rule, which fully takes effect in 2026. This is a severe landmine for high earners.
How so? What's the trigger?
The trigger is very specific. If you are 50 or older and your 2025 FICA wages, meaning the specific wages subject to Social Security and Medicare taxes from that employer, were over $150,000, your catch-up contribution is entirely restricted.
Wait, meaning that extra $8,000 you get to put in because you're over 50.
Right. That catch-up contribution must be a Roth contribution. The IRS completely eliminated the pre-tax option for that specific piece of the pie for high earners.
Let me explore why Congress would even do that. Usually the government wants to encourage retirement savings, right?
Generally, yeah.
So why suddenly force people into a Roth option where they have to pay taxes up front?
Well, it is entirely about accelerating tax revenue for the federal government. By forcing high earners to make post-tax Roth contributions rather than pre-tax deferrals, the Treasury gets its tax money today instead of waiting 20 years for you to retire.
It's an accounting maneuver.
Exactly. It's just a way to balance the federal budget in the short term.
But the trap here isn't the tax itself, is it? It's the administration of the tax.
Yes, the paperwork.
The documents outline that most existing solo 401k plan documents from standard massive custodians, the Vanguards, Schwabs, and Fidelities of the world, they were written before Secure 2.0 was even passed.
Long before.
So their default paperwork simply does not support Roth catch-up provisions.
Yep.
So if my standard paperwork doesn't allow a Roth catch-up, I guess I just file a tax extension or maybe write a note on my return explaining the situation?
No. Doing that would completely invalidate your plan and trigger massive IRS penalties.
Wait, really?
Yes. This is the institutional inertia aha moment of the whole document stack. In high finance, institutional inertia is your biggest liability. The law moved faster than the broker's legal departments.
Wow. It's like the government mandated a software update for your phone, but the app you use every day hasn't been coded for it yet.
That's exactly it. And if congressional law dictates your catch-up must be Roth, and your broker's plan document says we don't accept Roth, you are at a legal stalemate. You cannot simply override the plan document. You forfeit that $8,000 catch-up space entirely.
So what is the actionable fix for the listener who is staring down 2026?
You must take the initiative. Before making a contribution, you need to call your custodian and explicitly ask, does my current plan document comply with Secure 2.0 Section 603?
Section 603.
Yes. And if they say no, or if they sound confused, you have to formally amend your plan or move your account to a specialized third-party administrator. You are individually responsible for bridging the gap between congressional law and broker paperwork.
Man, that's intense. And since this Secure 2.0 bottleneck is already forcing us to look closely at the fine print of our plan documents, the sources suggest we look at a hidden feature you might want to actively add while you're updating that paperwork.
Right, the mega backdoor Roth.
Yeah. So let's talk about the mega backdoor Roth.
Well, the mega backdoor Roth requires 3 distinct elements functioning simultaneously. You need the right starting bucket, the right customized plan document, and the right tax reporting.
The pre-flight checklist for this is pretty intense. First, your plan must explicitly allow voluntary after-tax employee contributions. Second, it must allow in-plan Roth conversions or in-service distributions. And third, the administrator must separately track all the different buckets so the money doesn't get mixed up.
Because if it mixes, we're back to the muddy water problem.
Exactly. So the formula the document gives is simple. You take your 2026 annual additions limit, which is $72,000. You subtract the employee deferral you made, and you subtract the employer profit sharing you made. Whatever space is left over is your voluntary after-tax room.
Which means, if your business didn't generate enough profit to maximize that $47,500 employer bucket, the space doesn't have to go to waste.
Oh, that makes sense.
Yeah, you can fill the void with your own after-tax money from your checking account and then instantly convert it to Roth inside the 401k.
Okay, but we also have to deal with Form 5500 EZAs when we do this, right? The documents mention this form like it's a massive headache.
It definitely can be.
And if I'm doing all this paperwork and dealing with a 5500 EZ, which, just for the listener, is the mandatory IRS tax return, you have to start filing for your solo 401k once the balance gets over a certain size.
Right.
Why go through all that hassle just to put after-tax money in? We literally spent the whole first half of this deep dive trying to get pre-tax deductions to lower our current tax bill.
I get that, but you are trading a current deduction for permanent future immunity. It is all about the mechanics of tax-free compounding.
Immunity from taxes.
Exactly. By maneuvering an extra $20,000 or $30,000 a year into a Roth environment through this mega backdoor, that capital will literally never be taxed again.
Wow.
When that money compounds over 20 years into millions of dollars, you can pull the principal and the explosive growth out tax-free. It completely insulates your future wealth from whatever tax brackets Congress invents 3 decades from now.
Okay, that makes it totally worth the headache. So the solo 401k and the mega backdoor Roth are incredible tools for building wealth. but they hit a hard wall at that $72,000 mark.
Right, that's the ceiling there.
What if your income is so high that sheltering $72,000 barely makes a dent in your tax bill? That transitions us into what the training documents call the accelerator.
The cash balance plan.
The cash balance plan. If a solo 401k is a heavy-duty pickup truck, the cash balance plan is a mile-long freight train. It can carry an unbelievable amount of cargo, but once you get it moving down the tracks, it is very hard to stop.
That analogy perfectly captures the gravity of the plan. Functionally, a cash balance plan is a supercharged, defined benefit pension plan that behaves a bit like a 401k on the surface.
Oh, okay. How so?
Well, with a defined contribution plan, like a 401k, the IRS tells you exactly what maximum dollar amount you can put in today. But a cash balance plan uses an actuarial engine.
Meaning?
The limits aren't a flat dollar amount based on today. Instead, they are calculated backward from a future target.
Oh, the IRS caps the maximum benefit you can receive from a pension at retirement to an annual payout of roughly $290,000.
Right, that's the limit.
So an actuary looks at that $290,000 future target, looks at your current age, and calculates exactly how much money you need to contribute today to reach that target by age 62.
Exactly. And because of the math of compound interest, the older you are, the less time the money has to grow.
So they let you put more in now.
Yes. The IRS lets you shovel massive amounts of cash in right now to catch up. The scale is just staggering. The documents show that a 50-year-old high earner might be legally permitted to contribute $180,000 to $270,000 in a single year, entirely pre-tax.
That is absurd. But returning to the freight train analogy.
Yeah.
You cannot just decide to skip a year of funding because you wanted to take a 6-month sabbatical to travel, can you?
No, absolutely not. The setup costs alone are $2,500 to $5,000.
Plus another $2,000 to $4,000 every single year in actuary fees.
Right. And there is a mandatory funding discipline. Once you set a pay credit formula, the law requires you to fund it every year.
So if you have a bad year,
you're in trouble. The source material explicitly outlines red flags to warn people away from this strategy if they don't fit the profile.
like volatile income.
Exactly. Say you earn $600,000 one year and drop to $150,000 the next. The mandatory funding requirements of this plan will crush your cash flow.
What about employees?
That's the other big red flag. If you plan to hire non-spouse employees, the law requires you to contribute a certain percentage to your employees' pensions if you have one for yourself. That dynamic can quickly destroy the financial arithmetic for a small business owner.
Okay, so we've looked at the solo 401k pickup truck and the cash balance plan freight train in isolation. The ultimate revelation in this 2026 blueprint is that the IRS allows you to stack them together.
Yeah, the full stack.
You can run both at exactly the same time, but there's a very specific hidden catch involving combined deduction limits.
Right, because when you combine a defined contribution plan and a defined benefit plan, the IRS implements strict combined deduction limits. They want to prevent business owners from double-dipping on massive corporate tax write-offs.
That makes sense.
So assuming you have an owner-only plan without pension benefit guarantee corporation coverage, which is basically a government insurance program that covers large corporate pensions, but typically doesn't apply to owner-only professional groups.
Right.
The IRS penalizes your combination. Your solo 401k employer profit-sharing cap drops from 25% down to just 6% of compensation.
Wow. So you willingly sacrifice space in the 401k to open up massive space in the cash balance plan.
Exactly.
Let's build this step by step for the listener. The documents provide a scenario for an $800,000 earner. This is an independent professional, age 47, running an S-Corp, paying themselves that optimized $190,000 W-2 salary.
Let's look at the math for 2026. First, we look at the solo 401k employee deferral bucket. The business owner defers from their own paycheck, maxing out at $24,500.
Okay, bucket one is full.
Next, we calculate the employer profit-sharing bucket. Because they're stacking plans, this is limited to 6% of that $190,000 salary.
Which comes out to $11,400.
Right.
And then finally, we bring in the cash balance plan. Based on the actuary's reverse math, for a 47-year-old trying to hit the future pension target, they're allowed to drop $175,000 into the pension.
Right.
So you add the $24,500 employee deferral, plus the $11,400 employer contribution, plus the $175,000 pension contribution. That creates a total pre-tax shelter for 2026 of approximately $210,900.
And sheltering $210,900 from a 35% federal tax bracket saves almost $74,000 in federal taxes in a single year.
That is just incredible.
That money gets to compound for decades.
The training actually breaks this down into decision framework tiers. Tier 1 is for those netting under $250,000. They say, stick to the solo 401k. You don't need the complexity or the actuary fees of the pension.
Right, keep it simple. Tier 2 is the $250K to $400K evaluation zone, where a modest cash balance plan might start making sense.
But Tier 3?
Yeah, if you are netting $400,000 or more and you are over age 40, the full stack is almost mandatory.
Yeah, if you are in that Tier 3 bracket and you aren't deploying this strategy, you're literally volunteering $70,000 to $110,000 to the IRS every single year.
But the most crucial piece of advice for anyone in Tier 3 is mastering the timeline. The roadmap emphasizes an October deadline. You cannot wait until tax season in April to figure this out.
October. So fall of the current tax year.
Right. You must meet with your CPA and your actuary in October to adjust your fourth quarter S-Corp salary so you hit the exact right percentage. Plus, the cash balance plan legally must be established before December 31st.
Oh, wow. So if you wait till spring, you're toast.
Discovering in March that you could have sheltered another $100,000, but being blocked because the paperwork wasn't filed by New Year's Eve is an incredibly expensive tragedy.
It really is. Well, to recap our journey today, we started by mastering the diagnostic vocabulary, realizing that the muddy water of an old SEP IRA can ruin your tax-free growth.
Yeah.
We unlocked the two distinct buckets of the solo 401k and navigated S-Corp payroll dynamics to maximize the employer match. We uncovered the 2026 Secure 2.0 landmine, where institutional inertia is actively breaking paperwork for high earners over 50.
The broken apps on the phone.
Yeah, exactly. And finally, we looked at how to legally stack a cash balance plan on top of it all to shelter over $200,000 a year. It is an immense amount of financial power, unlocked simply by understanding the mechanics of your legal documents.
It demands a total shift in mindset. You move from being a passive taxpayer to a proactive wealth architect. The codes are complex, but the rules are written in black and white, waiting for you to utilize them.
I want to leave you with one final thought to mull over, something that isn't explicitly written in these IRS checklists, but bubbles right under the surface of this entire strategy.
Oh, I know where you're going with this.
Yeah. The premise of maximizing a cash balance plan requires relentless high-income consistency to feed that mandatory funding freight train. But the modern independent professional market is inherently unpredictable.
It definitely is.
So here's the paradox. By locking yourself into the ultimate, highly optimized strategy for financial independence, do you accidentally trap yourself in a high-stress, burnout-inducing workload just to make sure you can keep feeding your tax shelter? Are you serving the retirement plan, or is the retirement plan serving you?
That is a fascinating question to leave them with.
Thank you for joining us on this deep dive. Keep questioning the defaults, keep optimizing your systems, and most importantly, call your CPA in October. Until next time, remember the X-ray of your financial future is only as clear as the documents you build it on.